Hi everybody, today we're talking about bank stocks. Now we're going to be talking about banks in general, and luckily for us, banks have a relatively easy business model to understand. Now the banking sector in general has a lot of different services for finance, investing, etc. So first we're going to start with talking about how the commercial banking business model actually works. Now, commercial banks simply make money by taking in customer deposits and then lending usually around 90% of that cash to borrowers. Investment banks, on the other hand, work a little bit differently, and what they do to make some money is they manage some services such as asset management, stock trading, and they support companies through their initial public offerings onto the market, and in general provide financial services towards corporations, companies, and the government. And then we even have some banks which are using both the commercial side of banking and the investment side of banking, and they become a universal bank. These offer both those types of banking services, and these universal banks can by some people be seen as safer and more diversified. So now, although that's the general and main part of a bank's business, there are some other things that come in due to banks adapting to market conditions now and changing different ways and adapting and embracing the market, which means that now they offer merchant payments, credit card processing, and even sometimes insurance brokerage. Awesome, if you understand that, now that means we understand the business. So let's talk a little bit more about the stock side and investing in one of these banks. Now, unfortunately, banks are incredibly cyclical, and that means that the investment heavily reflects that and will be cyclical too. Now, this shouldn't come as a huge surprise, meaning that small things such as interest rates and loan losses can make huge effects to the business, which are all the result of economic conditions a lot of the time. Now, for example, let's talk about the interest rate. And it doesn't necessarily mean each movement for movement bank fundamentals will copy, but it does reflect strongly on profitability of banks, and thus the trading price is also affected. We can see in particular in between 2008 and 2009, there is a pretty significant drop in the earnings per share, market capital, net income, and trading price aligns at the same time as the interest rates plummeting. Now this occurs for both ANZ and Commonwealth Bank, as you can see, and most of their larger banks, primarily the big four banks, had a similar result from the interest rates declining. Now just quickly, if you could give me a cheeky thumbs up, that would really make my day. It does help the channel, it helps me with the YouTube algorithm, and it will help push this video to more viewers just like you. And if you'd like to see more videos just like this, also consider subscribing so the second I upload more videos, you'll be able to see them. Now, I hate to be that daunting person and just provide you with the cyclicality and the downsides of the stock, but now let's talk about one of the biggest and by far most debatably nicest benefits of bank stocks, and this is the dividends. Now, this has seemed to be the event for both smaller and larger banks, and that's where they seem to pay a pretty solid dividend. Now, banks can go for years and years, and due to cyclicality, you can sometimes potentially leverage off the stock prices declining to simply buy in at an affordable price to then hopefully receive the rewards when the economy repairs and larger dividends return. But I wouldn't say that a dividend investor should solely rely on bank stocks, and if you're looking for dividends, that's great. You may be interested in banking stocks if you do your research and you think it's a good opportunity, but in my personal view, it's always still important to diversify, especially because, and this is an important factor, banks are very heavily regulated, and a lot of them will be forced to cut their payout ratios in the event of some downturns. Now, banks are debatably one of the more heavily regulated industries, and whether you see that as a positive or negative is completely up to you, but in my view, for a longer term investor, it's not actually a hugely bad thing for the sake of knowing that minimum capital levels will be necessary to survive adverse environments of the economy. And then we have moats. Now, moats is something a lot of investors sometimes look for, but does a bank even have a moat? Well, in my views, it does have a moat. Now, besides the huge barrier of the absolute necessity to have low-cost funding and huge capital levels to actually start a bank, what else is there protecting certain individual banks from one another? The main moat, I would personally argue for a bank, and for banks, not all of them have it, some of them will. You need to look out for the ones that you think have a thicker, wider moat than one another. But this moat is, in my opinion, a switching moat. Hear me out. This is also something you can very easily argue against, so I'm going to talk about why this may not be true for all banking stocks. However, do hear me out that this may in fact be a moat for banks. Now I've got a whole lot of things that I've researched and put on my phone, so don't mind me, but I'm going to need to read these out. There's no way I'm going to be able to flawlessly read them all out, and I don't want to keep cutting the video for each individual fact. But 1 in 20 people have switched bank accounts in the last 2 years. 40% of Australians bank with the one they first opened up as a youngster, just like me. And on top of this, 60% of 18 to 24-year-olds bank where their parents do. And then on top of all this, something really interesting I found is that on average, people will stick with a bank for 17 years. People also on average will stick with a married partner for 11, meaning that in fact, people will spend longer married to a bank than they will to a partner. Just a very interesting fact, but this helps support my reasoning. Now, this means that banks are provided with very loyal customer bases due to the fact that there is somewhat of a hassle to switch banks due to the potential risk of direct debits and crucial payments going away. And although I may see that as a pretty big moat, I can also recognize that it may not actually be as wide as I think, because there's also a way to very easily bypass this, and then it just determines how strong is that. Now, for example, just sticking with Australia, because I know most of my viewers tend to be from Australia, just like me down under, but Westpac, which is a very popular bank here, offers a $50 sign-up bonus and then a $10 bonus on top of that for opening up an account with them. Now this adds up to a $60 incentive, and although $60 may not be huge, it may be enough to have people switch banks, or at the very least open a bank with a different bank such as Westpac. Now that's purely just a way of which it is bypassable. So far, still the statistics do show that people stick with the same bank. I don't think $60 is necessarily enough to make someone go through all that hassle. It's still a big deal. Even though you're not necessarily switching, you just need to open an account with someone else. Now I know that banks can't just throw money willy-nilly and give thousands and thousands to people to open up an account. However, the more and more they raise things like this, the more and more people may switch to different banking providers. So that's just a bit of food for thought for you there. You should always weigh up these sort of risks and these potentials out there. But something I would recommend checking out, something I would recommend researching in if you're looking to invest in a particular bank stock, is maybe look at how many customers they have and look at the growth of their customers, and hopefully there's no decline in their customer base. If they're growing at a steady rate compared to some of their competitors, that may in fact be a good sign from a business point of view for sure. However, you should also consider always other factors, more fundamentals, different things about them, their earnings. Everything matters, of course, not just your customer base. So it's just always good to look into all of these things, but that's just something I would recommend considering if you're looking to invest potentially into a bank stock. Of course, not at all financial advice. I don't think you should invest in a bank stock, although I'm not opposed to it. If you believe in it, good on you. You can do your research and do as you please, but I'm not giving any financial advice. I don't personally hold any banking stocks at the moment. However, it's something I continue to research, something I may in future invest in. I'm not sure, and you always need to weigh up all the research you do, all the risks, all the reward, everything. So thanks all for watching. I hope that this gave you a little bit of an insight, a bit of information about banks. I just conducted a little bit of research and thought it would be interesting to share with you all about banks as a sector to invest in. Let me know, have you invested in any banks? Do you want to invest in any banks, or do you stick away from them for any certain reason? I'd love to hear what pros, cons, anything you have to say regarding bank stocks. I'd love to hear it. Thank you all for watching, and I'll see you all in the next video.